Welcome to MuniLand. Visiting this week is Mark Paris, Senior Portfolio Manager at Invesco Municipal Strategies. He manages the Invesco High Yield Muni Fund. Good to see you.
Good to see you. Thanks for having me.
What's your outlook in the high yield space this year? Your fund returned close to 14% in 2012. Can you do that again in 2013? Are the conditions right?
Well, I think the conditions are pretty good, but to say that you're going to have another double-digit return year, and the previous year was pretty high, it would be a little bit, too bullish in our base case scenario. But however, spreads are still historically wide in the high yield muni area. New issuance is actually going to continue to be very low, and the credit worthiness of the credits that we're buying is still very high. So we believe that the high yield space is still a very attractive place to be.
All right, in terms of credit worthiness, about half of your portfolio is in non-rated funds. So how do you assess default risk?
Well, we assess default risk. A bond that is in default is a bond that is not paying its coupon. And right now, a little bit less than 1% of our portfolio is in that position. But it's 18 different names that comprise that 1%. So we believe that diversification is the best way to combat default risk. Also, credit research, bottom-up fundamental credit research is very, very important in the high yield sector. We do a lot of credit research. We have 15 credit analysts who are dedicated to the process, and we keep a very diverse portfolio. So we believe that default risk has actually been going down the last couple of years, despite some of the headlines that are going on, and that project revenue essential service bonds are going to do really well going forward.
What's the size of the average non-rated issuance that you see and it's in the portfolio?
Well, I think years ago you'd see non-rated issuance in that $10 to $15 million range. Now we see a lot of $100 million, even $200 million non-rated issues. I'd say the average size is something between 50 and 75 million, but there are a lot of bigger issues that come as well.
Now, your fund also has rated bonds, and about 20% is in triple B. Why is that a sweet spot for you?
Well, I think the triple B sector has really been benefiting from some of the negative headlines from general obligation bonds and what's going on in California. If you look at historical spreads between a triple B bond and a triple A bond, we're about a little more than 200 basis points or 2% cheaper than a triple A bond. And historically, that's pretty wide. In the summer of '07, we got as tight as 50 basis points. There's been a lot of issuance in the triple B sector, and I think that if you do good credit research, there's really good bargains to still be had in the triple B space.
In terms of the revenue bonds that you hold, over 90% are in revenue bonds, so primarily that's your fund. What's your turnover like generally? Is it consistent year over year, or do you change that turnover rate depending?
Yeah, our turnover tends to be in that 15 to 25% range. We're looking for relative value. We're looking for credits that have turned a little bit sour on us. We're looking to better our structure in the marketplace. The municipal bond market is really very much about structure when you're trading bonds, good coupons, good calls. So we're always looking for opportunities to better our yield that we're giving our clients, better our credit quality, and then you're going to have a certain amount of maturities come off as well. But I think 15 to 25% is a fair range. We've been about 18% the last 2 years.
Now, within the fund, you've got an interesting concentration in terms of sectors. You have so many bonds. Do you know how many are in your?
Over 1,500 bonds.
Yeah, it's amazing when you look at the list. But when you parse through it, about 35% is either in continuing care, retirement, or hospital. So what is it about healthcare that you're finding intriguing in that space? And does the argument for healthcare hold beyond high yield in terms of rated issuance?
We really believe it's a micro story rather than a macro story. Again, going back to the credit research, you want to look at each project financing separately from the marketplace. Yes, Obamacare is an issue. Yes, the Medicare, Medicaid reimbursements are issues. We like to buy projects where we own a mortgage on the facility, where we meet with management and understand where their goals are. We want to be in a area that's not overbedded and where we can understand the revenue flows that the hospital is dealing with. We really like in the hospital space the sort of primary access hospitals, acute care hospitals in the suburbs where you go when you break your wrist or you go to have your children. It's not really where you'd go for your more serious illness. Here in the New York care, you'd probably go to a major metropolitan hospital. But for the acute care stuff, of the minor stuff, you go to your local hospital, and they're really very, very well run. You can meet with management. You get a good sense of where the revenues are coming from. And if it's in a properly bedded area, they're really good investments.
You also have about 6% in tobacco. That's a little lower than some of the competitors in your space. Why aren't you as keen on tobacco as some of the others?
Well, we're keen on the space. It's been the best performer last year, but it's a very volatile sector. There's a lot of litigation issues that go into the tobacco sector, and so what we like to do is not all tobacco bonds are the same. Different states trade differently, different structures trade differently. We're more of an opportunistic buyer of tobacco. We did double our exposure over the course of the year from about 3% to about 6%. So we're looking opportunistically in the sector, but we don't want to own so much tobacco that it dominates the portfolio. If you look at some of the returns a few years ago when the downgrade happened, or early on in 2003 when tobacco really got hit hard, some of those overweight portfolios really suffered. So we would like to take a balanced approach, pick our spots where the opportunities are.
Mark Paris, good to talk to you. Thanks so much.
Thank you very much.
Let's take a look at our deal of the week with Thomson Reuters MMD's Dan Berger. Dan, what do you like in terms of the top deal this week?
The top deal this week is a $1.2 billion State of Washington general obligation bond.
And what is it that you like?
Well, I like a few things about it. First, it has very strong demographics. The next thing I like about it is that it has strong governance, which helps it anticipate its budget and helps it plan for the future. Next thing I like about it has healthy pension funds. And finally, what I like about it has an improved fund balance from last year.
So in terms of the rating, what are you seeing?
The rating is AA rated by all the agencies.
And risk factors. You had a couple of reasons why you liked it, but there's always risk.
There always is risk. In this one, there's no income tax, and it relies upon consumption-based spending for revenues. Another risk factor is that the debt ratios are fairly high, and they'll continue to remain so. And the third one is that they have limited budget flexibility because they've used a lot of one-shots to balance their budget.
All right, so in terms of the details, management, pricing, availability, what do we see?
It's going to be priced competitively next week, which means that dealers are going to bid for the bonds, and it's going to be priced competitively on Wednesday.
All right, Dan, thanks so much.
Thank you.
Let's look at the week ahead with MMD's Dan Berger. Dan, the fund flows ramped up this week. Is that going to continue next week? It's
possible they might. Fund flows were negative for December for the third time of 2012, when they lost about $2.7 billion. In the last 2 weeks, however, they've roared back, and they've taken in about $3 billion of funds.
At the same time, quality spreads have been compressed. They've been compressed for some time. Can investors expect to see any returns in the near term?
It's possible spreads may go up, but if what we're concerned about is that investors aren't being compensated for the incremental risk that they're taking. And it's possible spreads may go up just slightly.
And in terms of the calendar, does it look hefty for next week?
The calendar is going to increase manyfold. It was $2.7 billion this week, and next week it's going to be about $9 billion.
All right, MMD's Dan Berger. Thanks.
Thank you.
I'm Rhonda Schaffler. This is Reuters.